Welcome to our Cushman and Wakefield segment of 2021 Outlook. Hi Mark.
Hi Christine.
What do you think of the 2020 office market? Because the office market really saw a bit of a pullback. Our Grade A rents declined by about 7.7% in the first 9 months of the year, reversing the 2.8% increase in 2019. So can you walk us through the driving forces behind these numbers?
Sure. 2020, unprecedented. Like nothing most people have seen before in their real estate careers. But if we start to actually break it up, it actually becomes quite understandable. So the first thing to acknowledge is that at the end of 2019, is the market was cresting. You know, we had vacancy rates which were less than 3%. We had, overall A-grade rentals which were over $10.50, so very, very high. But the market was starting to come off. And that was going to happen because we had looming supply that was coming on in both 2020 and then 2021 and then going forward. So the market was going to start accounting for this new supply. So now we've got the real big event is COVID, and demand just stopped, hit a brick wall. And that's a real problem because historically, Singapore's added 1 million square feet of positive net absorption per year. So you take that out of the market and then you couple that with all this looming supply, something's got to give, and that was rentals. So we started seeing a little bit slowly in the first instance, but then an acceleration in the later part of this year in terms of the rentals. So that's why we're in the predicament that we are right now.
That's right. And COVID-19 really radically changed the way how we work. Do you think that this work from home is taking off very well in Singapore? And how do you see that playing into the occupier strategy?
It's on the top of everybody's mind is, workplace strategy, working from home. So what does this really mean? And again, you have to look in a historical context. So historically, companies would give every employee one work point. So it was a 1-to-1 ratio. Then all of a sudden, we just took our entire workforce and put them into the field. So we've gone from 1 to 100 in one second.
Yeah.
And that's a dramatic impact. Now, what's interesting is that lots of companies were experimenting with, agility or working from home in some component before COVID, and now everybody's having to do it. And it's causing every company to then to look at what is going to be their ratio in the future. Am I going to have my staff, 10%, working from home? Are they going to have it 20, or some instances, it's going to be 50 or more percent. So that's the biggest transition that we're seeing. And why that's so important is then companies turn around and say, well, if I don't need to have one work desk for every employee, I can maybe have 20% less, obviously their size is going to reduce. So that's going to be, demand is going to be impacted again. So this is going to be the fundamental change that we're going to see going forward. There's certain companies that are going to be way more affected. Companies who've had their business models completely dismantled or changed and are finding it really, really difficult. They're in expense management mode right now. There's others who are actually accelerating, but everybody's looking at this sort of saying, how much real estate do I really need? And that's the big driver force for 2021.
So looking into 2021, do you think all these factors will continue to influence the market? And according to our research, rents are projected to land at $9.54 per square foot per month by end of 2020, a drop of 10% from last year's peak of $10.66 per month per square foot per month. So are we expecting the kind of decline to continue, and how does it sit with the corporate occupiers?
So both those two points we talked about in terms of the supply-demand dynamic and in terms of the changing need of occupiers is what's going to drive the market and therefore the pricing. People get shocked when you start hearing that our market is going to go from being almost $10 or $11 per square foot in 2019 to $9 per square foot going forward in 2021. That's dramatic, but it's not surprising because we've got a significant amount of new supply coming onto the market. We've got Capita Spring, and we've got the looming Central Boulevard. So these buildings are going to significantly impact the amount of supply in the marketplace, and they don't sit vacant. And so they're going to suck in demand. And when that happens, demand's got to come from somewhere. And if companies are actually having lesser needs, then prices are going to reduce. So it's fundamentally, it makes sense why we're going to see the reduction. From an occupier standpoint, this is great. Obviously, anytime you've got a chance to reduce your expenditure, it's a positive thing. So companies are going to be really happy about that from an economic standpoint. Some groups may turn around and start saying, this is an opportunity for us to upgrade, to move to newer buildings with better amenities, new infrastructure, things that can cater to the new environment. Other companies are going to say, look, I'm just using this as an opportunity to save cost. So Those forces are fundamentally shaping what's going on in 2021, and absolutely rentals are going to reduce.
Yeah, just now you talk about supply, so maybe we can talk about a bit of the supply situation, because if you look at 2021, 2023, we have quite a bit of supply coming on stream, with about 1.4 million coming on stream in 2021 and another 1.8 million square feet coming on stream in 2023. So how concerned should landlords be?
Those are big numbers, right? Anytime you hear of 1 million square feet of new supply in a marketplace the size of Singapore, something's got to give, right?
Yeah.
The interesting thing is, if you go back and you look at what's happened in the market for the last 15 years, is we've seen this phenomenon a number of times. I call it the trophy building effect. Is when you put on a premium grade building, that's over 1 million square feet, every time this has happened, whether it be Marina One or Asia Square or Marina Bay Financial Center, it shocked the market, because it's so much critical mass of supply, and it has to fill up, because developers won't put on these magnificent buildings and have them sit vacant. They need to have tenants fill it up, and they're going to try and get whatever demand they can. Sometimes it's from the periphery, sometimes it's from maybe lower grade buildings, sometimes it's about amalgamation, but they're going to take demand. And pricing is the big thing that they can compete on. So they're going to work really, really hard to fill up these buildings, and that's going to cause the rental reductions. But if we did not have Central Boulevard and some of these buildings coming onto the marketplace, I would actually say that the Singapore market would be relatively stable, because our vacancy rate pre-COVID was very low, less than 3%. But now we've got these two forces, and we're definitely going to see some dynamics. So a little bit of a tougher scenario for landlords, more beneficial for tenants right now.
Yeah. I think it's also useful to talk about the co-working sector, because last year they took about 1 million square feet in office space around the island. And this COVID really disrupted their, the business model because of de-densification. So do you think that they continue to be significant in occupiers' portfolio going forward?
Absolutely. It's the short answer.
Yeah.
You're right. The co-working expansion was dramatic. They were the biggest take-up of space over the last couple of years. And it takes a while for the industry to adjust to these types of things. But it had. Companies were increasingly talking about flexibility or flexible space and co-working as part of their overall occupation strategy. So that was happening. But then you've got COVID and the density factor, and the co-mingling, really put a big crimp into the co-working model. If we start getting more relaxation, if a vaccine allows people to congregate in bigger areas, then I think co-working actually ends up getting a new lease of life and a real shot in the arm. And the reason is this, is that every organization as we go forward is trying to be more flexible. They don't have clarity about what their business plans are. And when you don't have clarity, you think short term. I don't want to make long-term decisions in case I get it wrong. And that's where the co-working model starts to come into effect, because it allows companies to take real estate on a short-term basis, and it allows it to do it without capex, which is another big problem for occupiers right now. They've got limited purse strings. Nobody wants to invest. So the co-working actually falls into the sweet spot for what landlords want, or for what tenants want. I personally think that co-working will have a resurgence. It's going to take a little bit of time. There's some organizations that may not make it, but I think fundamentally it becomes an offering that every tenant wants, and therefore every landlord needs to have in their property. Because if they're going to keep their tenants, they've got to have the end-to-end solution. So co-working, I think, is absolutely going to be part of the conversation going forward.
Do you want to talk about some silver lining for the office market? For example, Chinese technology companies, or maybe some of the demand drivers that we're going to see in the near future? Yeah.
So, and I get asked this question quite a bit, is what's positive? Where's the silver lining? And there's three answers I always give. The first one is never bet against Singapore. We're very fortunate. We've got a government that is pro-business, encouraging companies to invest and relocate and be in Singapore. And because we're a small country, we can do it very quickly and very nimbly. And whether it's the EDB or other elements of the government, they're actively trying to encourage companies to be in Singapore. That's one. Two is our infrastructure is phenomenal. Our Wi-Fi connectivity is great. The size of our houses is bigger than some of the other places in Asia Pacific. And we've got a workforce that's actually fairly adept to change. That's another huge advantage. So the last one is, people are looking at Asia Pacific and the world sort of saying, if I'm going to expand, and Asia Pacific is the place in which is still going to be a growth market in the future, where do I want to do that from? Singapore becomes it. So Chinese companies are starting to grow internationally and outside of Chinese borders. They're looking at Singapore as the first stop by which to expand into those places. And similarly, any other company, if you're looking at Asia Pacific for your growth strategy, where do you want to do it? Well, China's a little bit risky right now. India is different. Australia's pretty far away. Singapore's a shining light. So I think that all those things will naturally translate into growth and driving and opportunities for Singapore. So I'm actually very bullish, even though there's a lot of negative things happening right now.
Interesting. Okay. Thank you so much, Mark, for sharing your insights today. I think one key takeaway is this remote working is here to stay, and we're probably going to see how occupiers want to leverage on this and to see how much real estate agility they want to embrace in order to continue to attract talent and continue to maintain their corporate culture. So thank you very much.
Thank you for having me.
Thank you.